The story you are about to hear is not speculation, conspiracy, or exaggeration. It is a documented reality that has repeated for nearly 8 decades, across more than 90 countries, from Latin America to Africa, from Southeast Asia to Eastern Europe. It begins with an institution that claims to stabilize economies, prevent financial collapse, and restore growth, the International Monetary Fund. But hidden beneath this mission is a pattern so consistent that economists now refer to it as the IMF crisis cycle, a sequence of events that begins with rescue and ends with dependence, austerity, privatization, and often deeper collapse than the country started with. To understand how this system operates, we must step into the moments when nations were most vulnerable: when Argentina defaulted in 2001, when Greece was forced into austerity in 2010, when Indonesia's rupiah collapsed in 1997, and when Zambia's copper-dependent economy was dismantled in the 1980s. These crises, though different in geography and culture, display the same hidden architecture, the same script, the same playbook. At the beginning of every crisis, the IMF arrives with a familiar diagnosis: the country is spending too much, borrowing too much, and not producing enough. And while these problems are real, the IMF's solution follows a rigid formula that rarely considers the social, political, or historical context of the nation involved. Step 1 in the playbook is austerity: aggressive cuts to government budgets, social programs, and public services. When Argentina approached the IMF in 2001, its economy was already shrinking. Unemployment had reached more than 20%, and nearly half the population was slipping toward poverty. Yet the IMF demanded the elimination of public subsidies, reductions in pensions, and strict limits on government spending. As the cuts deepened, the economy contracted further, tax revenues fell, and the government had even less money to operate. Wages collapsed, schools lacked basic supplies, hospitals ran out of medicine. By December 2001, riots erupted across Buenos Aires and major cities, killing dozens and forcing the president, Fernando de la Rua, to flee the presidential palace by helicopter. The IMF later admitted that the austerity imposed on Argentina failed to take into account the depth of the recession, but by then the damage had already been done. The next major example came in Greece after the 2008 global financial crisis triggered a sovereign debt spiral. In 2010, Greece accepted a bailout package from the IMF and the European institutions totaling roughly 240 billion euros across multiple programs. The IMF insisted on wage cuts, pension reductions, layoffs of public workers, and enormous tax hikes. The results were catastrophic. The Greek economy shrank by more than 25%, an economic contraction comparable only to the Great Depression of the 1930s. Unemployment hit 27%. Youth unemployment topped 60%. Tens of thousands of businesses closed. Suicide rates rose sharply. The social fabric of Greece was pushed to the breaking point. Later, an internal IMF evaluation admitted that Greece's debt was known to be unsustainable from the start, but officials had approved the bailout anyway. This was not a rescue, it was containment, designed to protect European banks holding Greek debt, while the Greek people suffered the consequences. The second step in the IMF playbook is currency devaluation, a move framed as a necessary shock to make exports cheaper and restore competitiveness. But in reality, the immediate effect is inflation, the destruction of savings, and a collapse in purchasing power. Indonesia experienced this in brutal detail during the Asian financial crisis of 1997. When the IMF intervened, the Indonesian rupiah was allowed, or rather forced, to float freely. What followed was one of the worst currency collapses in modern economic history. The rupiah plunged from around 2,400 per US dollar to nearly 17,000 in a matter of months. Imported goods became impossibly expensive, inflation skyrocketed to 77%, and millions who had entered the middle class fell rapidly back into poverty. Businesses with dollar-denominated loans failed overnight, and the streets of Jakarta erupted with protests and violence. That eventually led to the resignation of President Suharto, who had ruled the country for 31 years. The IMF later conceded that its early measures worsened the crisis, but again, the reversal came long after the damage. A similar pattern played out in Mexico in 1982, when the country declared it could no longer service its foreign debt. The IMF required a sharp devaluation of the peso, which fueled a surge in inflation that reached more than 150%. Average Mexicans saw their wages evaporate in real terms, and poverty rates surged. In Zambia during the 1980s, The IMF required repeated devaluations of the kwacha. Even as copper prices, a critical export, were collapsing, the devaluations led to spiraling inflation, food shortages, and massive increases in the cost of living. Meanwhile, the government was forced to remove subsidies on essentials like maize, which triggered protests and riots. The result was a decade lost to contraction, with growth averaging near zero and poverty expanding sharply. The third step in the IMF playbook is structural reform, which sounds like harmless economic modernization but usually means selling off state assets, opening markets to foreign companies, removing protections for local industries, and reducing the role of the government in strategic sectors. In Ghana during the early 1980s, the IMF and World Bank pushed the country to privatize state-owned enterprises, liberalize trade, and remove price controls on basic goods. While some macroeconomic indicators improved, the social cost was enormous. Thousands lost jobs as industries closed. Farmer incomes were squeezed by competition from imported goods, and public sector wages stagnated. Zambia was also required to privatize its copper mines, which accounted for more than 90% of export revenue. The new owners cut jobs, reduced local investment, and sent profits abroad. By the late 1990s, copper production had collapsed, government revenue had fallen, and Zambia became even more dependent on foreign aid and external loans. Perhaps the most dramatic example of structural reforms took place in South Korea. During the Asian financial crisis of 1997, South Korea had built a strong industrial base through state planning and protection of key industries. Yet the IMF demanded the liberalization of its financial sector, the opening of markets to foreign investors, and sweeping corporate restructuring. Within months, foreign firms began buying major Korean banks and companies at fire sale prices, taking advantage of the crisis to acquire strategic assets. Unemployment surged above 7%, a number that may sound small, but was catastrophic for a country accustomed to near full employment. The social impact was so severe that millions of Koreans donated personal gold jewelry to help the government repay the IMF loan, an event remembered as the gold collecting movement. South Korea eventually recovered, but the IMF's policies permanently altered its economic model. The fourth stage in the IMF cycle is social unrest. Whenever austerity cuts social spending, whenever currency devaluation crushes wages, and whenever privatization leads to job losses, the people eventually respond with protest. Argentina's riots in 2001, Greece's mass demonstrations from 2010 to 2015, Indonesia's violent clashes in 1998, Zambia's food riots in the 1980s, Mexico's labor strikes in the 1980s all followed this pattern. In many cases, political leaders were forced out. Argentina cycled through 5 presidents in 2 weeks. Indonesia's government fell after 31 years of rule. Greece saw multiple administrations collapse under public anger. The IMF often claims these results were caused by previous mismanagement, not its own policies, but the timing is impossible to ignore. When IMF measures are implemented, unrest follows like clockwork. The fifth and final stage is dependency. After suffering austerity, devaluation, and privatization, countries often find themselves even weaker than before. Their industries are less competitive, their currencies are unstable, and their governments have lost the trust of the population. And so they return to the IMF for additional loans, beginning the cycle again. Argentina returned to the IMF multiple times after 2001. Including a record $57 billion loan in 2018, one of the largest in IMF history. Greece required repeated bailout extensions. Zambia went through more than a dozen IMF programs. Ghana returned in 2015 and again in 2022. These repeated interventions reveal the deepest truth. The IMF does not solve crises permanently. It manages them, extends them, and in some cases, deepens them. So why does this cycle persist? Economists who criticize the IMF argue that its true goal is not to rescue countries, but to protect global financial stability and Western creditors. When Greece was bailed out, most of the money went not to the Greek people but to European banks. When Mexico received its rescue package in 1982, the fund stabilized American and European lenders who held Mexico's debt. When Indonesia's banking sector was restructured, foreign institutions gained control. The IMF's stated mission is to prevent contagion and global collapse, but that often means prioritizing international investors over local citizens. The result is a system where countries in crisis are forced to bear the full weight of adjustment, while lenders remain protected. In the end, the IMF playbook is not about conspiracy. It is about power, incentives, and a model designed for financial stabilization, not social welfare. The tragedy is that many countries approach the IMF with hope, believing it will guide them to stability and growth. But the historical record shows a harsher reality: austerity that deepens recession, devaluations that spark inflation, privatization that weakens local industries, unrest that fractures societies, and dependency that keeps nations tied to external conditions for decades. Yet even after all of this, the IMF remains a central pillar of the global financial system because the alternatives are politically impossible, financially unstable, or institutionally weak. As you reflect on these stories, remember that every crisis has winners and losers, and those who write the rules of global finance rarely lose. Thank you for watching. If this video helped you understand the hidden patterns behind global financial crises, make sure to like, share, and subscribe to the channel. Your support helps bring more historical deep dives, economic investigations, and untold stories from around the world. Until next time, stay curious, stay informed, and keep questioning the systems that shape our lives.